Welcome to The King of Business. In this episode, we will explore the 2008 financial crisis, an event that shook the global economy and changed the world of business forever. Discover how the housing bubble formed, the fatal mistakes that led to the collapse, and the lessons we can still learn from this historic financial disaster. Get ready for an in-depth and revealing analysis that will help you better understand the business world and avoid the mistakes of the past. The 2008 crisis that ruined millions vertical bar. The housing bubble burst. The burst of the housing bubble in 2008 and the subsequent global financial crisis were unprecedented events that transformed the world economy and financial system. This crisis had complex roots and multiple intertwined factors that led to one of the worst recessions since the Great Depression. Here is a more detailed and extensive analysis of the events and consequences of the crisis. In the years leading up to the crisis, there was significant liberalization in mortgage lending standards. Banks and financial institutions began offering subprime mortgages to borrowers with weak credit histories and low incomes. These mortgages often had low initial interest rates that adjusted upward after an introductory period. The deregulation of the financial sector during the 1980s and 1990s allowed banks to engage in a wider range of investment activities. The Gramm-Leach-Bliley Act of 1999, which repealed parts of the Glass-Steagall Act, allowed financial institutions to combine commercial and investment banking, increasing their exposure to risks. Banks packaged mortgages into mortgage-backed securities, MBS, and sold them to investors. These MBS were often mixed into collateralized debt obligations, CDOs, complex financial products that were difficult to assess for their real risk. Rating agencies gave high ratings to many of these products, underestimating their risk. The Federal Reserve kept interest rates low after the burst of the tech bubble in 2001, which encouraged borrowing and investment in real estate. Cheap credit boosted housing demand, increasing prices and creating a speculative bubble. New financial products and practices such as ninja loans, no income, no job, no assets, and adjustable rate mortgages proliferated, allowing more people to enter the housing market, even those who could not afford it in real terms. When interest rates began to rise, many people with adjustable rate mortgages saw their monthly payments increase significantly, leading to a wave of defaults and foreclosures. The large number of foreclosures increased the supply of homes on the market, leading to a significant drop in property prices. As prices fell, homeowners who had bought houses with high mortgages were underwater, meaning they owed more than their homes were worth. Mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, quickly lost value as subprime mortgages defaulted. Banks and financial institutions that had invested in these products faced massive losses. The crisis reached its peak in September 2008 with the bankruptcy of Lehman Brothers, one of the largest investment banks in the United States. Other banks, such as Bear Stearns and Merrill Lynch, were acquired in emergency conditions, while AIG, one of the world's largest insurers, was bailed out by the government due to its huge losses in financial derivatives. Uncertainty about the solvency of financial institutions led to a credit crunch. Banks stopped lending to each other and to businesses, paralyzing economic activity. Interbank interest rates spiked, reflecting distrust among lenders. The credit crisis impacted the real economy, leading to a global recession. Unemployment rose sharply, and many businesses closed. Economies around the world contracted, and international trade plummeted. Governments worldwide implemented bailout packages to stabilize the financial system. In the United States, Congress passed the TARP, Troubled Asset Relief Program, which provided $700 billion to recapitalize banks. The government also intervened to ensure bank deposits and support troubled financial institutions. To revive the economy, fiscal stimulus policies were implemented. In the United States, the 2009 economic stimulus package included investments in infrastructure, tax cuts, and direct aid to families. Other countries adopted similar measures to boost economic growth. The crisis led to a re-evaluation of financial regulations. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, increased oversight of the financial system and established new consumer protections. New regulatory agencies such as the Consumer Financial Protection Bureau, CFPB, were created, and stricter rules for financial derivatives were implemented. The crisis led to a reevaluation of mortgage lending practices. Regulations tightened, and lending standards became more stringent. Consumers became more cautious about buying homes, and the growth of the housing market slowed. The crisis left lasting distrust in the financial system and the institutions that comprise it. Many investors and consumers became more cautious, demanding greater transparency and accountability in the financial sector. The crisis and subsequent recovery exacerbated economic inequalities. While some areas and sectors recovered quickly, others lagged behind. Disparities in wealth and income increased, and many low-income and minority communities were disproportionately affected. The crisis also led to a wave of financial and technological innovations. The rise of fintech and the popularization of cryptocurrencies are partly a response to distrust in traditional financial institutions. New lending platforms and financial services have emerged to offer alternatives to traditional banks. The financial crisis weakened trust in political and financial institutions. Many citizens blamed governments and financial elites for the crisis and resulting inequality. This led to a rise in populism and political movements promising economic and financial reforms. The financial crisis and subsequent global recession sparked protests and social movements in many countries. In the United States, the Occupy Wall Street movement emerged in 2011 to protest economic inequality and the undue influence of large corporations in politics. The crisis also led to political reforms in many countries. In Europe, the Euro crisis and bailouts to countries like Greece led to debates on fiscal and economic integration within the European Union. In the United States, the response to the crisis included reforms in financial regulation and changes in monetary policy. Michael Burry, a hedge fund manager and founder of Scion Capital, was one of the first to identify the fragility of the subprime mortgage market. Starting in 2005, he heavily invested in credit default swaps, CDS, betting against subprime mortgages. His predictions and strategies were popularized in the book and movie The Big Short, which shows how Burry and a few other visionaries profited from foreseeing the collapse. In 2005, during a conference honoring then Federal Reserve Chairman Alan Greenspan, Indian economist Raghuram Rajan presented a report titled, "Has Financial Development Made the World Riskier?" warning about the increasing complexity of financial products and the accumulation of systemic risks. Although initially dismissed by many attendees, including Larry Summers, Rajan's warnings proved to be extremely accurate. Amid the crisis, important documents related to subprime mortgages and financial transactions reportedly went missing. These documents were crucial for assessing the magnitude of toxic assets and the financial liabilities of various institutions. The disappearance of these files has fueled conspiracy theories about deliberate cover-ups to protect top executives and involved financial institutions. The crisis left lasting distrust in the financial system and its institutions. Many investors and consumers became more cautious, demanding greater transparency and accountability. This distrust also fueled the growth of financial alternatives, such as fintech and cryptocurrencies, which aim to offer more transparency and lower costs. The crisis led to a reevaluation of many traditional economic theories. Some economists suggest that the crisis revealed fundamental flaws in the prevailing economic theory, particularly in risk assessment and the interconnectedness of global financial markets. This has led to a greater focus on behavioral economics and understanding the complexity of the financial system. The crisis also catalyzed a wave of financial and technological innovations. The rise of fintech and the popularization of cryptocurrencies are partly responses to distrust in traditional financial institutions. New lending platforms and financial services have emerged to offer more transparent and accessible alternatives to consumers. The Federal Reserve and other central banks adopted unconventional monetary policies to address the crisis. One of the most notable measures was the implementation of quantitative easing, QE, which involved the massive purchase of financial assets to inject liquidity into the economy and lower long-term interest rates. These policies had lasting effects on the global economy, keeping interest rates low for an extended period and changing the dynamics of financial markets. The crisis also spurred interest in cryptocurrencies and blockchain technology. Bitcoin, created in 2009, was a direct response to distrust in the traditional financial system. Its decentralized nature and promise of being an alternative to fiat money have attracted many users and investors. Blockchain technology has also found applications in various sectors, from finance to supply chain, promising greater transparency and security. The crisis exacerbated economic inequality, highlighting how the effects of a recession can be uneven. Low-income communities and minorities were the hardest hit by job losses and declining property values. Government bailouts, while necessary to stabilize the financial system, were also criticized for disproportionately benefiting large corporations and high-income individuals. The 2008 financial crisis was not only an economic event, but also a catalyst for profound changes in regulation, technology, and culture. The effects of the crisis continue to shape the global economy, and the lessons learned remain relevant to avoid future crises. The combination of human errors, the complexity of the financial system, and political responses has left a lasting legacy that continues to be studied and debated. And that brings us to the end of this episode on the 2008 financial crisis, an event that forever changed the global economic landscape. From risky lending practices to the complexity of financial products, history has taught us valuable lessons about the importance of regulation, transparency, and accountability in the financial world. Remember, knowledge is power, and understanding the past is crucial to navigating the future. If you enjoyed this video, don't forget to give it a like and subscribe to The King of Business for more content on economics, finance, and business. Leave us your comments and share your thoughts. What do you think we can learn from the 2008 crisis to avoid future financial catastrophes? See you in the next episode. Until then, keep reigning in the world of business.